Imagine a single day in February 2025 when President Donald Trump, freshly into his second term, announced sweeping tariffs on imports from Canada, Mexico, and China, sending the Dow Jones Industrial Average tumbling over 1,000 points and wiping billions from global markets in hours. Did your portfolio weather that storm, or are you scrambling to protect your wealth? Welcome to Hedge Haven, your premier destination for unlocking the financial secrets of the ultra-wealthy, tailored for investors across the United States, United Kingdom, Australia, Canada, Germany, France, Norway, Switzerland, Denmark, and the Netherlands. Today, I'm diving deep into Trump's 2025 trade war to uncover what's really at stake for investors. Can I break it down in just 10 minutes? That's the challenge. But stick with me for this comprehensive deep dive, because the insights you'll gain could redefine how you safeguard and grow your fortune in this era of economic upheaval. From stock market volatility that keeps hedge fund managers on edge, to sector-specific disruptions in agriculture, manufacturing, and technology, and from currency fluctuations to untapped opportunities in offshore banking and luxury real estate, we'll explore how Trump's latest tariffs are reshaping the global economy. Whether you're a hedge fund titan, a private jet owner, or an aspiring high-net-worth individual, this video is your roadmap to navigating the chaos of Trump's trade war with precision and confidence. Let's dive in. Trump's trade war, reignited in 2025, has sent shockwaves through global finance, building on his first-term policies but with even bolder ambition. At its core, it's about the U.S. imposing tariffs, taxes on imported goods, to protect American industries, curb trade deficits, and address issues like illegal immigration and the fentanyl crisis. But these moves have triggered fierce retaliation, with countries like China, Canada, and the European Union slapping tariffs on U.S. exports, from energy to consumer goods. For investors, this spells uncertainty on a massive scale. Let's start with February 1st, 2025, when Trump imposed 25% tariffs on all goods from Canada and Mexico, 10% on Canadian energy resources, and an additional 10% on Chinese imports, citing a national emergency. China responded with 34% tariffs on U.S. goods, escalating to 84% by April. On March 26, 2025, Trump targeted automobiles and auto parts with a 25% tariff under Section 232 of the Trade Expansion Act, hitting non-USMCA imports hard. Then on April 2, 2025, he announced a 10% baseline tariff on nearly all foreign imports, effective April 5th, with higher reciprocal tariffs for countries with large U.S. trade deficits, like 125% on China, 20% on the EU, and 26% on India, set to begin April 9th, but paused for 90 days except for China. By April 15th, steel and aluminum tariffs were restored at 25%, and on May 1st, the de minimis exemption for low-value Chinese goods was scrapped, piling on import duties. These aggressive policies, enacted under the International Emergency Economic Powers Act and other trade laws, aim to boost U.S. manufacturing and energy dominance, but have disrupted global supply chains and inflated costs. For the ultra-wealthy, whether you're managing a hedge fund in New York, diversifying assets in London, or investing in luxury real estate in Sydney, this is a direct threat to your portfolio, from hedge fund returns to offshore account stability. Protectionism may shield domestic industries, but it risks higher consumer prices and slower global trade. If you're an investor with stakes in a tech giant like Apple, reliant on Chinese manufacturing, or a hedge fund betting on commodities, these tariffs could erode profits overnight. Yet amidst the chaos, there are opportunities for those who know where to look. Tariffs and trade disputes create a massive challenge for investors. Market volatility. When countries engage in tariff wars, it's like tossing a wrench into the global economic engine. Consumer prices rise, corporate profits shrink, and markets swing wildly. Take February 1st, 2025, when Trump's tariffs on Canada, Mexico, and China were announced. The Dow plummeted 1,200 points, the S&P 500 shed 4%, and global indices like Japan's Nikkei and Germany's DAX followed suit, each dropping over 5% in a week. This unpredictability is a nightmare for investors, even the savviest in high finance circles. It forces tough choices: hold steady, pull out, or shift to safer assets. Investor psychology shifts to fear, driving demand for safe haven investments like gold, which surged 7% in Q1 2025, or U.S. Treasury bonds, prized for stability. For ultra-wealthy investors in the USA, UK, or Switzerland, luxury real estate in stable markets, think a Mayfair penthouse or a Zurich lakeside villa, becomes a hedge against inflation and market swings. Hedge funds thrive in this environment by deploying sophisticated strategies, using derivatives like options and futures to hedge volatility or shorting stocks of tariff-hit companies. Algorithmic trading, which dominates 60% of U.S. equity trades, amplifies these swings, as high-frequency algorithms react to tariff headlines in milliseconds. If you're a high-net-worth individual, diversification is your shield. Spread your portfolio across domestic tech giants like Microsoft, stable European markets like Germany, or offshore accounts in the Netherlands to mitigate risk. The key is to stay calm and strategic, because while volatility shakes out the unprepared, it rewards those who plan with precision. The trade war's impact on specific sectors is where the stakes become crystal clear for investors. Let's start with agriculture, which has been hammered by retaliatory tariffs. American farmers, especially in the Midwest, faced a crisis when China imposed 34% tariffs on U.S. agricultural goods in February 2025, escalating to 84% by April. Soybean exports, a $14 billion market, dropped by an estimated 60% in Q1 2025, costing farmers billions and forcing reliance on government aid. Hedge funds betting on agricultural commodities had to pivot, while others saw opportunity in domestic agribusinesses less exposed to trade disputes. Manufacturing is another sector under siege. The 25% tariffs on steel and aluminum, restored on April 15, 2025, and the 25% auto tariff from March 26th, hit manufacturers like Ford and General Motors hard, with Ford estimating a $1.5 billion profit hit in 2025 due to higher input costs. These costs are often passed to consumers, fueling inflation, or absorbed, squeezing margins. Technology firms face supply chain chaos, with Apple warning that the 125% tariffs on Chinese goods could increase iPhone production costs by 25%, prompting a shift to manufacturing in India and Vietnam. The Nasdaq dropped 10% in April 2025 as tech stocks reeled. But there's a silver lining. Domestic industries like healthcare and US-based tech giants are gaining favor. Companies like Pfizer or Amazon, with strong domestic footprints, saw investor interest surge as trade tensions escalated. For the ultra-wealthy, luxury real estate is a powerful hedge against tariff-driven inflation. Prime properties in Manhattan, London, or Sydney's harborfront hold value, especially when paired with offshore banking in Switzerland or the Cayman Islands to secure liquid assets. Hedge funds are also capitalizing, betting on commodity price swings or shorting tariff-hit manufacturers, turning disruption into profit. The stock market is a live battlefield for the trade war's effects, with volatility driven by every tariff announcement or trade talk. On February 1st, 2025, when Trump unveiled tariffs on Canada, Mexico, and China, global markets tanked. The Dow fell 1,200 points, and the S&P 500 lost 4% in a day. Conversely, when Trump paused most reciprocal tariffs on April 9, 2025, markets rallied, with the Dow gaining 3% in 2 days. These swings underscore the market's sensitivity to trade policy. Algorithmic trading, accounting for over 60% of U.S. equity trades, fuels this volatility as high-frequency algorithms react to headlines faster than human traders. For high-net-worth investors, this demands agility. Timing the market is tough, but top wealth managers use stop-loss orders, options, or volatility-linked ETFs to limit downside risk. Offshore accounts in stable jurisdictions like Norway or the Netherlands offer flexibility, allowing swift capital moves during market dips. At Hedge Haven, we emphasize working with private wealth advisors who understand trade war dynamics, ensuring your portfolio thrives in any market. Diversifying into domestic tech stocks or stable European indices like Germany's DAX can buffer US-centric volatility. Hedge funds profit from swings using strategies like pairs trading or volatility arbitrage. A playbook the ultra-wealthy follow closely. Staying proactive is critical. Hesitation in this trade war era can be costly. Trade disputes ripple across the global economy with profound implications for investors. The International Monetary Fund warned in March 2025 that Trump's tariffs could shave 1% off global GDP by 2026, a $1 trillion hit. Slower global trade weakens corporate earnings, consumer spending, and economic growth, impacting markets from New York to Frankfurt. Currency markets are turbulent. The US dollar strengthened 4% in Q1 2025 as investors sought safety, while the Chinese yuan and euro weakened by 6% and 3%, respectively. For ultra-wealthy investors, this opens currency hedging opportunities. Betting on safe haven currencies like the Swiss franc or Japanese yen, which gained 4% and 3% in 2025. Offshore banking in Switzerland, the Netherlands, or Singapore provides a shield, parking assets in stable economies with favorable tax regimes. The trade war has accelerated a trend among the 1%, relocating wealth to politically stable jurisdictions like Zurich or the Cayman Islands to protect against global uncertainty. Luxury investments, from rare art to high-end real estate, face pressure, but prime markets like London or Sydney remain resilient, with property prices rising 5% in 2025 per Knight Frank's wealth report. If you're a private jet owner or hedge fund manager, these strategies are likely already on your radar to safeguard your fortune. How do you protect your wealth amid Trump's 2025 trade war? The impact on investment strategies is seismic. With tariffs driving uncertainty, investors are pivoting to industries less tied to global trade. Domestic healthcare players like Johnson & Johnson or tech giants like Amazon are safer bets than manufacturers exposed to tariff-hit supply chains. The ultra-wealthy go further. Luxury real estate in prime markets like New York, the south of France, or Sydney hedges against inflation, with prices up 5% in 2025. Gold, surging 10% this year, is another haven. Offshore banking in the Cayman Islands, Switzerland, or Singapore offers tax efficiency and asset security. Hedge funds are doubling down on sophisticated plays, shorting tariff-hit stocks, or betting on volatility indices like the VIX, which spiked 50% in February 2025. For Hedge Haven viewers, the takeaway is clear. Diversify aggressively, plan strategically, and work with advisors specializing in high-net-worth portfolios. Allocate 20% to safe haven assets, 30% to domestic equities, 10% to offshore accounts, and the rest to flexible instruments like hedge funds or private equity. This balanced approach ensures resilience no matter how the trade war evolves. As we wrap up this deep dive into Trump's 2025 trade war, the key takeaway is that it's not just about tariffs, it's about the broader implications for investors and the global economy. From market volatility to sector disruptions, currency shifts, and opportunities in offshore banking and luxury real estate, this trade war is redefining high finance. At Hedge Haven, we're committed to empowering you with the 1%'s strategies, whether hedging volatility, securing assets offshore, or building a legacy through ultra-luxury investments. The ultra-wealthy don't just survive storms, they thrive by staying ahead. So what's your move? Are you diversifying into domestic tech, exploring offshore banking in Zurich, or snapping up a Mayfair property? Share your thoughts in the comments. Let's keep the conversation going. For more on thriving in uncertainty, check our video on top investment strategies for turbulent markets, link below. Subscribe to Hedge Haven and hit the bell to join our high finance community across the USA, UK, Australia, Canada, Germany, France, Norway, Switzerland, Denmark, and the Netherlands. Until next time, keep building your wealth smarter, bolder, and faster.